Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
So today we are going to start the top of the show talking about something that is extremely familiar to Brian. This is how Gen Z outpaces past generations in the home ownership race. Guess what? Gen Z is making their presence known, but in a new category of culture, becoming homeowners. Right from the top, Brian, we're going to get into this. Wow, man, Gen Z's taking over. What do you got to say about this? Like, we're going to get into some details, but like, hey, take the mic, man. Run with it.
So I wrote down right here on my notes, millennials are pushing to go back home or still living at home, while Gen Z is like, yo, I'm out. I want out of here. Like, I don't want this. I'm not trying to live with my parents. I'm trying to do my own life, whereas millennials are a little bit more inclined to like, hey, like I could live at home or I could offset certain things, and they'll look at it more of an opportunity to save money rather than, the Gen Z like, I'd rather just, go full force, figure it out, and get the heck out.
Okay, so now I am like, I'm putting you on the pedestal right now to like start talking about this. You're literally at the cusp of these two different generations, so I know you're like at the very last tail end, maybe even the last week of what the millennial window is. I know it's not that, I'm exaggerating. The reason I'm talking about Gen Z though is like you have these clients, you have these friends, and they're at the beginning edge of this because there's still a lot of Gen Zs that are younger that aren't even going to qualify yet. But I mean, what does this mean to you when you read this? I think it's indicative of the cultural shift we've seen and the attitude about homeownership that is different from the millennial and the Gen Z, and even Gen X. But also, like, I think this forecasts where we're going. I think there's going to be a lot more of this coming, again, taking into consideration all of the affordability issues and rates and high home prices. But there's clearly an appetite for this with Gen Z.
So I want to say when I first started in the industry, I was 22, 23. And at that moment, I don't believe I saw a lot of people in my age group at that time looking to buy houses. It was more still trying to figure out what they were going to do with their life, career, school, or, still just trying to figure it out. But the difference is that this year, in most, I've had clients range anywhere between 21 as low as 18 at some times, all the way up to like 24. And these are people that range between, two boyfriend and girlfriend, military young couple. And the military young couple was actually a pretty surprising one because when I started talking to them, they were still living on base. They were barely going to start getting their BAH, although they weren't able to get approved for something here in San Diego. That mindset and that want was already, hey, I don't want to stay in military housing. I'm not trying to, just go quote unquote do the rental life here. They wanted to actually purchase. And for them, it was more about creating a clear path and understanding like, hey, once you rank up, if you're doing this, you're going to by default be able to purchase a little bit more because of, your incentives.
Okay. So, part of our conversation, when we talk about the generations, we start seeing these patterns, right? Where you see some millennials go, I don't want to have the same experience my parents had when they lost their house in the financial collapse, the global financial collapse of 2008, 9, 10. So you see a lot of that attitude like kind of ingrained. But then I'm noticing that there's a different attitude in Gen Z where they're like, after it, dude. They're like, hey, whatever I got to do to go and get this thing, I'm going to just get after it. Whether it's having multiple borrowers or having friends participate in the purchase of the home, or house hacking like we've been talking about. And so now I feel like they're kind of going, let's say, against the current of the generation right before them, which is not as averse necessarily to what happened in the Great Financial Collapse because they were younger, didn't know about it, or maybe they frankly don't care. I mean, do you think there's a level of internal competitiveness that's just like, hey, whatever, I'm a competitor, I'm going to go get it?
Yeah, I honestly, I agree with that. And when you said experience, I think that's a really key word to describe this because I felt through that experience in 2008, 2007 when we lost our house. And, one of the reasons why I got more into real estate was because I wanted to understand more how actual housing, loans, and everything worked. But I do feel that, it's more of a experience like, hey, I don't want to go through that pain, or hey, I don't want to go through that stress. Hey, I saw my parents, that really, forecast the way that you're going to think once, you're making those decisions. And it's showing up in a lot of, our generation. I mean, you could see here by the numbers, whereas the Gen Zs, I feel they weren't even, how do I say it, aware enough to be able to say, hey, this is what they experienced. It's more like they were either barely being born or it had already passed by the time that they were born and, kind of doing their life.
Because it's kind of like,
for the most part.
But what you're kind of tiptoeing around, like it's not historically relevant anymore.
No.
To a certain point. Like it now exists. It exists like in books and in stories you hear on the internet and like YouTube shorts.
I think the closest catastrophe that we could go back to that's the most relevant is COVID 2020. So before you go through any other real estate meltdown or crazy times, we're going to go to 2020. And I think that's where a lot of Gen Zs are drawing a lot of their, their wants, their experience, their opportunities because of everything that kind of unraveled from there. Whereas millennials, I felt like just leading up into that was when we were ready to start buying, but then everything kind of fell through. And, some people got, I think, the shorter end of the stick.
I think there's a little bit of embitterment that happened because of that. Because I know, I've talked to people too that are a couple years ahead of you, and they're like, "Hey, I was in high school. I remember us losing our house, or what." I'm not going to say the situation, but there's a lot of that, and so I think they're a little bit more embittered and maybe hesitant because, like, hey, I don't get burned again, or I don't want that. Like, I saw what my parents went through. I saw what I went through as a teenager at that time. I don't want none of that noise. But this generation, though, you have to think that the GFC was 16 years ago. Okay, so someone who is, let's say, 19 now, they were 3.
Exactly.
And someone who's 24 now, they were what, 8?
Yeah.
Okay, so what grade are you in when you're 8 years old? Like second grade, maybe? Maybe second or third, I don't know, whatever grade you're in. Let's say you're in early elementary school.
Yeah, elementary.
But compared early elementary school to being in high school and having awareness of your home situation economically, there's a huge difference in that.
And I think in that time period of your life, you're a lot more sensitive and more reactive to certain things that's happening around your life because I feel like, it's all about me. And you kind of grow with that. So I feel that also starts showing in your later years of life where I'm like, hey, I don't want to make that decision because based on past experience, I already know how that leads down the line. Whereas Gen Zs are just like full send, like let's figure this out, let's see what happens, and if it doesn't happen the way that I want it to happen, well, at least we still tried. And I actually will quote from the article. There was a Gen Z girl, Dominic Vericchia, that purchased, and he was very optimistic. He said, I don't know if I was making the right call buying a home. I didn't know if I was going to turn me upside down. And I feel that is a huge feeling for everybody, but the difference is that I'm still going to go through with it regardless.
Okay, go back though. So you're quoting this guy Dominic, right? But so here's what I want everyone who's watching this to know. Dominic, it said 24-year-old homeowner Dominic. So he's 24 today.
Yes.
He purchased in October of 2020. There was a massive amount of uncertainty, and this dude's like, "Oh, house on fire," and he like runs in it, right? Now he got a loan. It says here 2.83%.
Oh yeah, I mean, come on now.
Who wouldn't die for a 2.83% right now? And here he either had maybe he didn't have the foresight necessarily. Maybe he was like, "Hey, I don't know any better, but I'm gonna go buy a house anyways." Maybe he did have the foresight. Who knows? Maybe this kid's a financial planner. We just don't know it.
But you know what? Like
20. My point is, he was 20 when he did this. So clearly, there's people that are in this age bracket that are like, you know what? I'm getting after this. That competitive part. That's why I brought this up earlier. Is I think this is a demonstration of that and it's going to be more indicative as a common denominator for them because again, quoting the article, 27.8% of 24-year-old Gen Zers are homeowners. That's a lot. That's more than millennials and more than Gen X.
And what I think is crazy also is that if you want to buy, you're gonna buy regardless. But at the same time, I feel that when you're younger, you have a lot more opportunity to take risks without having as big a repercussion.
You can hit the ground and bounce a little bit still.
Yes, exactly. So even if, let's say, it would have gone the other way around, the investment or the property, he wasn't able to keep, he's still within a young age where he could literally just wash, rinse, repeat, and start all over again without having a huge impact on his life, financial life, and family. Whereas someone that's near 30s or a little bit older, has a family, has a stable job, has real rooted responsibilities, it's more of a gamble, or more of a unsure decision whether you want to make a move and buy right now. Whereas you have to make more of a calculated move. Whereas someone younger that has no responsibilities, you could right off the bat say, hey, let's shoot, and then I'll aim and figure it out as you go. If you're not in that position, everything else needs to be more calculated, more planned out, and you can't really just say, "Hey, I'm gonna throw, just shoot and say, hopefully, I hit the target."
And that just call a spade a spade. The reason we're sitting here talking about this, and they use this story with this kid Dominic, is because this happened, but we're looking at it from the rearview mirror.
Yes.
We're citing that he bought this in October 2020. Okay, that's 4 years ago at this point. We're citing that he has a 2.83% mortgage. Well, that's 3 times lower than the rates were just October ago, and so. Like, we have to be real. That is true for him back then when he was 20 that this worked. It doesn't work for some people now. But that doesn't mean that their appetite's gone away. Mm-mm. So kind of in rounding out this thought, the housing market still is what it is with elevated prices. He's even saying here, by the way, I didn't know if I was making the right call. He's even admitting I didn't even know, and I didn't know if it was going to turn me upside down. But what's happened to the property values since October 2020? like they're on average up like 30 to 40% depending on the part of the country you're in.
Even if you didn't keep it anymore, he's up. Yeah, exactly.
That's what I'm saying. He could have bought this house for $200,000 and he's still at like what 300, maybe 350 or something like that. So again, he did that. I think it's just a great example. But rounding out the idea to close up this section is, what would you tell people who maybe they are the Dominic but they missed the window? Now what do they do?
Yeah, that was a really good question because that's what I was gonna ask next. But I honestly feel
how about answer it?
Yeah.
Now that I asked it.
Well, that's a really good question. And before I get to that answer, I'm just gonna give you a great question, by the way, but I will get
just
to it.
Answering questions with questions. So what do they do? What do people do?
I honestly, from what I've seen and experiences that I've gone through or heard, I think it's diversifying yourself in a way that you're either going to come in with more money, have a co-borrower, or just get creative with the fact of how you're going to purchase a house. If that's still in your goals and everything checks out, like, hey, if I'm able to split it with a co-borrower with my partner or with a bunch of buddies, then if you're able to come up with a plan that works for you, then I think you should still go forward with it. But if you're doing it on your own, it's very expensive. You're at the edge of your debt to income ratio, and you're kind of like putting everything on there, then it's going to be a tough cookie to swallow. So I feel that you should probably ease off. But if you have the right support, you do have the finances in line, and you could withstand maybe 6 months to a year of an elevated payment, then I think you should definitely take that option and look what it looks like for you.
So in summary, take a look if you're curious.
Yeah.
If you're curious and you qualify, then take action, but also be measured in your choices.
And there's
Is that a good summary?
No, 100%.
Okay.
And there's something that I'll dive into in a little bit later on the article is that I think being prepared right now is going to really put you in a situation that when everything starts dropping, a lot more people are going to come in, but you're going to have the feasibility of being able to move quickly rather than someone that, hey, rates drop, I'm just getting approved, I want to go shop. People that already had been approved, they're already basically dropping offers on the property that you were looking at. So.
We can't sit here and pretend like there's this negative outcome for being prepared. There just isn't.
And it is. It's like it's not going to hurt you at all to be prepared. Like the worst thing that could happen is you're in the best position to be able to make the best offer so that you can get your offer accepted.
If I'm really going to be picky, here's what you can't get back: your time in preparing.
Oh no!
If it doesn't work out, it doesn't work out. But that's the consequence. Is it didn't work? Okay, well if it happens to work, then you're going to end up being homeowner in the end.
Yeah, and I have an example of that exact thing that we're doing right now with one of our clients where we're getting ready, we're getting prepared. We're not going to pull the trigger yet, but we're going to put ourselves in a position that, once the time is right and we're at the right level or the tier where they want to make the move, we're going to easily be able to get it done in a feasible amount of time, not, take our time and then, lose 2 weeks before we can actually start making it happen.
Solid, man. Yeah. Solid. Let's move on. We're going to talk about mortgage rates because mortgage rates stay flat as housing market enters a buyer-friendly fall. I'm gonna take issue with the title because I think this is more of a clickbait title than anything.
Yeah.
I don't think it's a buyer-friendly fall because we have an inventory problem. And the inventory problem is holding up the pricing problem, and the pricing problem is underpinning the affordability issue. And mortgage rates being flat doesn't really work for anybody that is like an inch and a half away from the sidelines to get in the field.
Yeah.
So buyer-friendly. I'm not so sure I'm 100% behind the title, but the point here is that mortgage rates kind of stayed flat. So they had come down a little bit at the beginning of August, and then they kind of hovered. They were like kind of tinkering up and down a little bit here and there throughout the weeks, and then they've kind of flattened out.
Yeah,
so
yeah, definitely.
I think broadly what this is, without going too hard into the details right at the top, is I think this is just because everyone's waiting on the Fed.
Yeah.
I think they're just waiting on the Fed. The Fed's going to come out with their decision in the middle of September, like we know. Everyone's waiting for it. It was, will they or won't they? And now it's, will they do a quarter versus will they do half?
And
I think they're going to do a quarter.
And last week we had some pretty good economic data come out, but even then I noticed that the market didn't have much movement. It was very small gains, if any, and we would basically go up, come down, and end off pretty even.
That typically means that they were expecting that,
yeah,
and so it came in as expected. Even if the news was better or worse, if it's what they were already projecting, like privately, kind of off sheet, then they're like, it's what we expected, no big reaction. So for mortgage rates, we're kind of in this conventional sixes, and then governmental high fives, low sixes for VA FHA.
Yeah.
That's important to know. Home prices, I mean, the claim here is that, okay, mortgage rates flat. We've established that. The other claim here, though, is that home prices continue to drop. But I'm going to not so delicately remind you that them dropping does not mean that they're plummeting and falling off of a cliff. Yes. It was not too long ago that our median home price was still in the 300s. Then it crossed into the 400s, and now it was like in the 420s and like low 430s. So for it to go from like 436 back to 429, we're not having some sort of like cataclysmic meltdown in housing price. It's negligible at best.
And I think we're going through that period of like people waiting to see what's going to happen, like you said. And I believe that if there's still sales that are increasing, that's only an indicator that when things start coming down even more, there's going to be a lot more pressure and a lot more buyers looking to get into properties.
That's true, but here's where you have to step back from the talking points and go, well, why are they increasing? Because there's more inventory.
Yeah.
So like if you say, oh, well, house prices are up 30% from last year. Well, duh, there was like 2 homes sold last year. So, okay, we sold 3 this year. They're up 50%.
Because, and if you think about it, we've seen a slowdown in inflation. The labor market is softening, and that I think creates a runway for houses to continue to go up a little bit higher.
More inventory, which means there's some price pressure, which means they're going to go, oh, home sales are up. Well, of course they're up because they were in the trenches like 12 months ago. So anything better than 2023 is going to look better. But and again, they're all kind of pieces of the same puzzle, and we talk about this and go around and around in circles about this because it's important to know it's not complex, just the interconnectedness of the variables. So house price and inventory and rates and affordability and the amount of homes that go into escrow and pending sales and then final close recorded sales means there's more home sales. So some of it is not a big surprise. It's just you have to be diligent enough and patient enough to look at it and see it for what it is.
Yeah, and I agree with what they say here. I feel that we are going to have a rather more busier fall than other years, just because I feel there's a lot of people waiting for their tier to get there, right? Once they get to the level that, hey, the rates are there, or hey, my person got in, or hey, inflation, that's where it needs to be. People are on the fence. People are waiting, and that's only going to create more pent-up demand as we move into next year. So my prediction is that we're going to end off very, 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 not very busy, but we're going to be busier than other falls and winters. And then leading into 2025, we're going to have a lot of momentum as well for the people that, are waiting for 2025. And as soon as that hits, the first couple of months, see how the market is. Spring's going to come roll around, and there's another wave, and then summer, and then that's where I feel we're really going to start seeing how everything kind of starts, really coming full circle from all the past, data and years.
I agree. I think what happened is our buying cycle is shifted forward by a quarter. I think what's going to happen, what we're already seeing happen in our fall is what we're expecting to happen in the summer.
Yes.
And what's going to happen in the winter is what we expected in the fall, and what's going to happen in January, February, March is what we normally expect in the winter. I think we're kind of like a dial. We just kind of turned it to the right by a quarter turn. And that's what we're experiencing.
I agree.
I think a lot of that has to do with the Fed. I think the economic stuff going on, and I think honestly the election. I hate to say that there's something there, but I think there is, and I think no matter who the winner is in the end, I think home buying is going to be the winner, and here's why. I've overheard, and also talked to directly people who are kind of voting for person A and person B.
Correct.
And in their own way, they have a reason to wait. But then they have a reason to buy, and they represent 2 different candidates. So they're like, oh, well, if he wins, then I'm definitely going to do this because I want to make sure I have my own thing. And then if she wins, I'm definitely going to do that because I want to make sure that da-da-da. And I'm like, okay, so basically everyone, at least in this little tiny survey of a couple people, like they're all saying they want the same thing, but they're still going to wait to see who it is. I don't hear anyone that I talk to saying, well, if person A or person B wins, well, screw housing altogether.
No.
No one has said that.
No.
So it's like all attention is going in the same direction regardless of who the person is who comes out on top.
And I think that's, more than we think, more people than we think that are in that boat.
Right. That's why I brought it up.
Yeah,
I think it's indicative of a larger population of people.
I also just feel because people are so conditioned to say like, hey, they're going to solve our problems, or, so conditioned to, believe that someone's going to come and basically, make everything better, that they put a lot of their faith, their trust in hoping that this is going to make their situation better, when in reality, unfortunately, that's not the case. And it's a huge combination of a lot of other things that's happening around your world that really dictates, the direction of where we're going to go, how you're going to go. And the government is just a small fraction of that.
Yeah, and then you look at the details in this. So I shed this whole opinion and some little experiential anecdotes here. Yeah. But then when you look at like kind of the details, they comment here and talk about like median price and that kind of thing, and people who are now buying at the higher median price, again, I've made the argument before. Sometimes the way things are written, I think I like the specificity, but there's sometimes a little bit of disingenuous attack angle. And I'm going to give you an example right here, which is for the 14th week in a row, the median list price in the U.S. was less than or equal to what it was in the corresponding week of the prior year in 2024. Well, yeah, duh, of course, there were less homes and the prices were higher. So the natural mathematical consequence of supply and demand is when there's more inventory that comes up, there's more price competition, and then you see subsequent weeks in a row where prices ease up. But again, it's not a cataclysmic meltdown. And here's the other part. They're using 14 weeks. Okay, how many months is that, Brian? 2.5? No, I'm sorry, 3.
Three and a half.
Sorry, 3.5. Someone's going to be like, Doug said 2.5 in the comments. So 3.5 months. Okay, so 3.5 months out of 36 months. Put it that way. Let's not just say 14 weeks in a row it's slid. Well, okay, well then what context of time? If you want to look back at 36 months, okay, well it's 3.5 months out of 36. Now it's not that big of a deal, is it?
And then any number that comes out for these next 2 months leading into October, November that comes out for this year is by far going to be way better than what data we had last year, because October, November were the horrible worst time since rates started going up. So anything you compare, and I'm going to, we'll circle back to that when the data comes out in October, November, but anything that, is a slightly positive or better, it's going to just, alarm everywhere, and you're going to see it in the headlines. Hey, this year compared to last year, amazing. Oh, this and that. But in reality, if you really look at it from the big spectrum, we're just catching up to what we lost.
And let me add this last little piece of this is that, the whole median price falling 14 weeks, falling or staying equal for 14 weeks in a row. You know what the difference has been? 0.9%. So over this 14-week period, there's been a 0.9% adjustment to what it was a year prior. That's negligible statistically speaking. And at $429,000, you're talking about $4,300. So I'm not really too worried about that. It's just those things where it's like you can say 14 weeks. You could also just say 1 quarter out of, I don't know, 12 quarters.
I think you called it out, right? It's just the way that they deliver that seems a little bit kind of sus.
Yeah. A little sus.
Yeah.
Hey, I'll use some of that Gen Z
but
language.
Like regular people
that's sus, fam. Facts, no cap.
Yeah, you know what I mean? Like people that don't know this, they're like, oh wow, that's really alarming. 14 weeks in a row. Whoa, that's a lot. That's more than 10.
Yeah. 14 weeks. What's 3 years times 52? 156. Yeah, 14 out of 156.
Oh God.
Take that to the bank, guys. Next article, Brian, we got to talk about mortgage refinance demand, 94% higher than a year ago. That sounds like a crazy number. It's true. That is actually down from 150%. Since we're talking about inflated and conflated statistical numbers here in this segment of the show, mortgage rate refinance demand, 94% up from a year ago. Duh. We saw this. Rates went down in August. This seems like a super layup, slam dunk. I want to talk about, though, the impact of this carrying into the fall. We were talking about how we think there's going to be more activity because behaviorally there just seems to be a wave of people who re-piqued their interest, and they are like looking at housing as something they want for a variety of reasons, politically and personally. But, I mean, look, man, the refinance numbers don't lie, and I know, like you do, some of this is people fixing their financial problems.
Oh, yeah, definitely.
Whether I like it or not, whether our comment section likes it or not, that people are using their house to cure some financial issues, hey, doesn't matter whether you care or not. If it's fixing something in their life, they're still doing it. So
no, 100%.
Go yell at your neighbor, I guess. I don't know.
Thankfully, we just closed on a cash out refinance for a client that's going to be wiping off all their debt. And I actually had an example about, the refinance. So we have a client that I've been speaking to. We closed last year. They had a 1.0 buy down. The rate got bought down from 6.99 to 5.99,
okay.
Last year.
Just for a year, though.
Just for 1 year. Okay. So it's adjusting this year in December when their first payment was made. So essentially, they have, we told them, hey, in a year, rates are going to start coming down. And, 6 to 8 months, we're going to start tracking rates, seeing where they're at and seeing, when the right time to make that jump. We started, we talked last month, briefly kind of gave them some numbers, came up with an idea, kind of formulated a plan. And I told them at the end of August, let's regroup, let's run the numbers so that in September, we can get everything in line, your application, your paperwork, have your loan submitted, or at least start shopping for a home for your refinance so that as, we move into the later months of September when, the feds are anticipating to have a rate cut and we start seeing more data come out, we start seeing how the market takes that into consideration, then we're going to be in a really good position to move very quickly on your refinance at the time that rates drop to the to the levels that you guys would like it. Anything under 5.990, they said that it is good. They're okay with that, or just being at that payment so they don't go up 1 full %. So
what? Tell me real quickly though, because I don't want you to just keep like blast past the point. Cash out immediately. People.
Oh, this is a rated term.
Cash. Oh, I thought you said it was cash out.
No, that was just another example. So no.
Okay.
So to clarify, yeah, this exact example that I'm talking about is for a refinance, a conventional rate and term.
Understood.
And they're simply going to be taking that rate down, or not allowing the rate to go up 1%, and they're going to be additionally saving anything that's under that 5.90 if we're able to lock them.
They're basically securing their note when they hadn't had it secure before it was going to adjust.
Yes.
So, but quickly though, go back to the cash out. So because I know people, it's a point of contention, but why would you take cash out of your house? Look, I know not everyone agrees. Sometimes people make bad behaviors. They have bad behavior spending wise, and it just causes problems. And if your money, your income can't cure it, and you made some bad choices, sometimes the house is there as kind of a relief valve to relieve some pressure. But we've seen time and time again people we talk to that are saving anywhere from $400 and $500 a month to like $1,300 a month. And I'm saying saving because it's out-of-pocket savings difference of paying your mortgage that's at a low rate, plus all this credit card debt, car loan, student loan, medical bill stuff. So I understand, but you have to take the long view once again. Like they could also cure that debt by selling their house. They're just choosing not to sell it. That's still the house doing the heavy lifting of paying off the debt. That's my argument. But in this case, Brian, like tell me real quickly, like what is going on that they were doing the cash out right now versus just a rate and term, whatever.
So they came to me because they had accumulated over the last couple of years a lot of credit card debt, a lot of just personal loans here and there. So for them, it got to the point where I'm like, yo, we have enough equity in the house. We're paying, I want to say they were paying close to $1,800 and just residual like monthly debts for credit cards and all that.
You mean like personal debt obligations?
Personal debt obligations
on
top of their mortgage and car payments and stuff like that.
Okay.
So for them, they got to the point where like, hey, we have enough equity, we just want to cash out and basically pay for everything, put it all into the property. They were at a 5.75 rate when we did their purchase about 2 years ago. We locked them in at a 6.25, and this is where I'm advising my clients to leverage the high rate, knowing that it's on the way down. Because if you have the equity, you can tap into your cash. Your rate's gonna go up maybe by a quarter to maybe an eighth of a percent, but in 6 to 8 months to maybe even a year, you'll be able to refinance that a little bit lower, still take your cash that you needed at that time, and then save more on your monthly payment.
Did they happen to use some of their equity to pay for buy down or no? They could have, right? So it could have stayed at 5.75.
They could have, yeah. Virtually, they could have. They could have paid maybe like a point to 0.75%.
What's the out-of-pocket exchange they're making? Because if they're paying $1,800 of just personal debt obligations every month, but their mortgage payment goes up in the loan amount and it goes up in the interest rate, what was the exchange there?
So their savings is still like $700.
Okay. Oh wow.
So yeah.
Okay.
So I mean, from cash that was going out.
That's what I'm saying. Total out of pocket is
exactly.
a difference of $700.
Yes. Yeah. So I mean that going right back into their pockets and no extra
no
debt
consumer
payments.
Debt.
Exactly.
Yeah. Okay.
And that's more or less what I try to explain to my clients, that's where the power is at. That's where the leverage is at. We had an inverse situation of that where a client wanted to cash out refinance. They spoke to a financial advisor. Their financial advisor completely told them, hey, don't do a cash out refinance, do a HELOC.
Right.
The difference is, and I researched this, is that, depending on what you utilize that HELOC for, certain tax, deductions alternate as well.
Interest cannot be deducted depending on what you used it for unless it was for capital improvements on the property.
Exactly. So in this case, none of that was, done. It's same thing to pay off debt.
Yeah.
So,
that may or may not be a bad strategy. I'm not going to side with him or you on this. I'm just saying
that's the point that I was trying to drive home. That I said, well, in your life, what's the best, what's the best solution for the problem? You have two of them already.
Yeah.
So either way is going to solve your problem.
You're rocking two problems right now, dude.
But they, I told them, like, look, what's one thing you're always going to pay, regardless?
Yeah.
Your house, right? That's the main thing, your main payment, right? Now, you're still going to pay your house, but additionally, you're also going to be paying your HELOC for whatever you use. Down the line, you're going to have to either pay that off in full or refinance it into your property. So I said, whatever way you take, I just want to make sure that you solved your problem. But I will let you know that if you don't have that lump sum right now, what's the chances of you having it later?
Yeah, I mean, let's say you're expecting some sort of windfall event. You're going to come into some inheritance money, or you're selling something else like a business or whatever. Like that could be a case for making an alternative choice. But if you don't have an alternative choice, I totally understand.
Yeah.
This. The other thing too, and I'm going to say this, is that when it comes to your financial planner, there's also a lot of other assets in play.
Yeah.
You may not know what they got in their 401k, their IRA. Is it rollover? What time? How old are they? When are they retiring? Like there's all sorts of other stuff. Maybe they have a plan to retire and move out of state. So in 3 years or 5 years, if that's the case, and it may not be.
No, of course.
My argument is there's a point where that's fine that the financial planner has that take. That's fine. You can still do the transaction, help them save the money.
Yeah.
Doesn't matter. I mean, in the end, it doesn't really matter. No, because the client still needs the help.
And that was my point, regardless. I told them, look, whatever decision you make, as long as you get your problem solved, like that's all that matters, man. Like I don't want you to do something that you don't want to do, but if that makes sense for you, take that.
I think that we're going to continue seeing numbers like this with refinance demand being high, partially because the numbers were so low last year, but partially because of the uptick of activity with rates going low. And then once the Fed has their rate cut in the middle of September, that's going to, again, they're not directly connected to the mortgage market, but it influences and plays into it. That's going to, I think, draw more people in to go, okay, cool. Now rates are down another 1/4 or 0.5% on the mortgage side of things. Now that's my strike point. It makes sense for me to do this. Let's make the move.
Yeah, and very simple. I mean, don't wait to get ready when rates drop. Get ready now and wait for rates to drop.
Yeah, be ready.
And you're going to be in a way better position. And I'm going to keep driving that point home because it's like, trust me, once things start dropping, you're going to see from one week to another applications spike up, competition go up, more houses are going to start hitting the market. And by the time that you want to get ready, that property's probably already sold. That transaction's already done. People are already getting into contracts. So you're going to have to wait for the next wave.
The way I've been looking at this is like waiting for an Uber ride to go to the airport on vacation. Like when do you start packing? When the car's already there or before the car shows up?
And
start packing now.
And now you have the ability of putting a timer when you want to get picked up. So I mean, like the planning is there, like, hey, I want to refinance in 6 months. Maybe I should start getting ready in month 2, 3.
Yeah. I know that in the past when, back when I was still doing a lot of loan activity, I had people like, well, what if I do that now and it gets even lower in 6 more months? Like I have no clue if that's even going to happen. Neither do you.
No, I don't have no crystal ball, which I wish I had.
Yeah, and it's not just that. But you know what it really came down to? And maybe this is for somebody watching this segment of the show, this part of it is maybe it just comes down to this. Like, in which way will you be dissatisfied? Are you going to be dissatisfied that you locked your loan today and it's lower tomorrow? Or will you be dissatisfied even greater if you floated it today? Instead of locking a lower rate, it goes higher tomorrow and you missed out on the one you had in front of you. So, pick which way you're willing to be dissatisfied and then make your choice from there. That's literally how I had to tell people sometimes.
Positively dissatisfied.
Yeah, but because it was coming from a place of I don't know what's best to do in this situation. It's uncertain to me a little bit, and so I had to reframe it. I didn't need anything out of it by reframing it. It was to help the client make a choice because he was struggling. I don't know what to do. I said I would say you lock it today because we don't know what tomorrow, and here's why I think that. And he's like, well, yeah, but what if it da da da? I said, listen. What do you want to call me and be mad about tomorrow? That we floated and it's higher, or that we locked it and it's lower? He goes, I'd be mad if we floated and it was higher tomorrow. I said, okay, well then let's lock. He goes, you know what? Yeah, let's lock. And I didn't need it to lock today or tomorrow. He just asked me the question. I was like, he's just coming from a place of uncertainty and kind of pre-admitting how he was going to be dissatisfied one way or another. And then he was able to make his choice. So
I think that's a great way to put it. You don't tell them what to do, but you give them the options of what they can do.
Yeah, I can't.
It's a tough cookie because I've been in that position too where they're asking me, well, what should I do? And it's like, it's not so much saying, hey, you should do this, but rather giving them like the pathway and the way, like, hey, well, these are your options. Where do you? It is
our job to have that conversation. Though it's our job to have the conversation and answer the question when we're asked the question. I can't do it for him. But I had to help him understand like what choice he was making, what the consequence of deciding or not deciding were, and that's true for everybody. And some people are like, hey, whatever, I don't care. So a lot of it had to do with more of the personal behavior. Yeah. And again, maybe this is for somebody who is feeling that same way. Well, there you go. You can ask yourself that same question and make the choice that's best for you and your family given that circumstance.
That's always the best decision you can make.
Brian, let's close out the show with this last one today. The Fed. Our favorite people, the Fed. Favorite. Is this going to get us canceled? The Fed won't push the panic button and go for a jumbo rate cut, an economist says. I initially agree because I don't think that panic dropping the rate by 50 basis points would be helpful. That would actually, to me, that would suggest that they actually knew something worse is happening, and they still came out several weeks ago and were like, we feel it's time to finally easing our policy. That okay, well, you said that kind of real soft if you're going to come out and drop a 50 basis point bomb drop on us. So that's my take. What do you think?
I'm sticking in line to what I've been saying these past couple of weeks. Elevator up, stairs down. It's gonna take time for us to get back down to where we would like to be. But then again, that's what we need to do in order to keep things, in line, controlled, because if we start cutting like crazy, that's going to send different signals, different, demeanors to the market. That could,
it's going to signal for sure. It's going to signal for sure they waited too long and they didn't do it quicker. They waited too long. They could have acted sooner. They knew something and didn't tell us.
And that doubt of what do you guys know that the markets don't? Oh, that in itself would cause so much panic that we'll see red for a couple of days.
Bro, I agree. I think that maybe part of the argument is, and this is I'm going to say it so that no one else has to say it. This is 100% speculative coming from Andy.
Ooh. I
think that the rewrite of the jobs of 880,000 is why people are kicking around the fact that we may have to do 50 basis points, and they're just not mentioning it. Well, I think that's a huge correction.
I did. Bro. I saw all of them were corrected.
880,000 jobs said to be created that were not. If there were any reason,
gone.
Well, remember when that came out, people on TV were like, "Oh, should the Fed do an emergency rate cut right now?" And other people were like, "No, they shouldn't, because then that means that this thing carries way more
weight
with
the tail
than what they've been saying for the last 2.5 years.
100%.
We need to restore price stability to the markets, and we need to ensure maximum employment." Well, they did ensure maximum employment, but then they actually had to correct that number, and oops, it wasn't maximum. There's a big black eye if you just come out with an emergency rate cut. That would have freaked the markets out more.
100%. I do agree.
I do not think that means they will do 50. I'm saying I think it's just why they're talking about 50 could be on the table. I ultimately think it's only going to be a quarter, because I think they're going to do this low and slow. Like you're saying, elevator up, stairs down. They're going to do 100%. Low and slow. They'll do a quarter in September. They'll probably do a quarter in November to end out the year.
That's literally what I had on my notes. Maybe another one.
Yes, and and again, we're going to be in that time frame where it's election time, and there's going to be a decision and all that, and
a lot of pressure too.
Unfortunately. I want to start a whole separate show where we talk about like banking, the Fed, and like politics. I don't want to do it here, but here's the reality. So cool. Everyone wants to pretend, or they want to claim that the Fed is independent and they're not persuaded by other people. That's a bunch of crap. They are. We know they are.
They're all in the same. They're all in bed together.
Right, but then I also understand why you would want them to have neutrality. Yeah, I would want that too. But there are certain things that you have to do on behalf of the benefit of the economy, and they are painful. There's 100%. Not like it's not Halloween where every door you knock on there's going to be candy and sweets. Some you're going to knock on a door in the economy, it's going to punch you in the mouth sometimes. That's what we're living in right now. That's what we see.
I can guarantee you they're having some difficult, very, very difficult conversations behind closed doors that only maybe a 10% of what we know is actually disclosed to us truly.
So, part of this is them just making their decision. The data and them being so data-driven and data-dependent is basically forcing them to have to do that, even if the timing right now is what they were hoping for. Coming out for a year and a half, 2 years saying you're going to be data-dependent, data-driven, data-dependent. Now you're seeing data that was unfavorable. Well, now you have to make a choice. You're kind of like beholden to the thing you said you should.
We said we were going to do this, but then now you got to do it. Well, no, it's just
So they I think doing nothing is definitely not a choice. So they have to do something. There's that issue. I think that there's going to be more about jobs. I think when we look back, first quarter of 2025. I think we're going to look at the end of 2024, and we're going to see how people are being counted as employed, but it's the same person holding multiple jobs. So we had said this before on the show, where, I'm gainfully employed at business A. I'm also gainfully employed at business B. There's two jobs in the economy, but it's still one person doing it. So when you measure it by jobs, some of that is distorted, even if it's only negligible. Statistically, it's still being distorted because these people that are holding 2 jobs or 3 jobs, they're still counted as 2 and 3, not one person here, one person there. So I think that is going to come back, and I think that they know that, and they already know that's kind of baked in the recipe of some of these numbers and this data. And because of that, again, silently and not being said, I think that's also what's going to drive some of these rate cuts is they can only allow so much softening of the jobs market, which is short for unemployment.
Yes.
Before they have to do something and let businesses start spending on employees again.
Oh, 100%. Or else we're going to break the economy more.
We can't afford that.
No, we can't.
We can't afford that. We can barely afford now.
Well, we can barely afford shit.
You know what? We're already at 40 minutes close on the show. We can't afford to do a 41st minute. We're going to be out of here.
Yeah,
so.
I know. So thank you guys.
More on the Fed. I wanted to keep that one short because really the talking points about the Fed are going to come up after they make their decision.
Yeah.
So let's just wait till then.
Everything's speculative up until.
I wanted to bring it up because this is going to make the rounds kind of right before the Fed decision comes out. And I would like to see what happens because of that, because I know that week's show we're going to be talking about a lot because 100%. It will say a lot, even if they don't say a lot. The data will, and even sometimes the things they skip over mentioning is the things they should be mentioning.
They kind of brush it through real quick.
All right. Brian, favorite part of the show? Go.
Honestly, my favorite part was the whole show. We had great talking points for every article. I think we went back and forth. It was really good. I mean, we had, contradictions. We agreed with some stuff, and I really think we had a really well-rounded show this time around. I was actually like, oh, wow, I want to hear this one back.
Well-rounded. Cool. Like my midsection. So my favorite part of the show was the first article, actually, how Gen Z outpaces past generations in homeownership. I am so excited about that because I'm the elder on the show today again. So, 45 right now, and I love that this generation coming up behind us is like, you know what? I'm going to get some home. I want some, and I want to be an owner versus a renter. I like that a lot. It definitely jives with me. If that's how I was raised, that's why we do
anybody, if you want to buy a house and you have no obstacles, pretty sure everyone's going to say yeah.
Yeah. Yeah. You already see a greater percentage of them buying homes than millennials and Gen X. So I love that
which is
Gen
good
Z
because
doing that.
That hopefully just turns a new way for generations to come forward.
But here's the thing I'm going to tell you. So that's my favorite part of the show. But here's, I guess, my caution. I didn't really say this at the front because I just thought of it right now. Is like, hey, if you're the millennial and you're a Gen X, watch out. Gen Z's coming for the house that you're also looking at. They're out there and they seem aggressive and hungry. So with that, have a great week. Hit the subscribe button. Like the show. Send this to a friend or a loved one who you know and love who needs to win in mortgage and real estate. I'm Andy.
I'm Brian.
And we'll see you again next week.
Bye, guys.